What is up, everybody? Welcome back to another episode from Coin and Capital yet again. It's Chris, and on this channel, we bring charts, we talk about economics, we talk about macro, we talk about crypto, and we discuss what's going on in the world, right? Trying to find some truth amongst all the noise out there. And today, guys, today, my country, Canada, what was once home to a thriving middle class turned culture diluted, borderline communism, is in the hot seat today. Because today, guys, we're going to talk about recent policy talks from the Bank of Canada, recent pushes in financial reform from the Bank of Canada, and discuss a little bit of some growth scares that have been rearing their head due to new policy being implemented in Canada. So stick around, guys, because we're going to talk about it. We're going to find that truth, and let's get right into it. The truth about Canada. Guys, the truth about Canada is that for the last 10 years, this country has been fragile, to say the least. We have been running subpar productivity, substituting that for immigration, for money printing, and hyper financializing by relying on the banking industry, the banking sector, to shoulder the weight of what could be a extremely rich and extremely profitable natural resource sector. And of course, this fragility, this subpar productivity, this reliance on debt and money printing to fuel growth reflects itself in markets. Because here, guys, on the right, we have the Canadian 30-year, the tip top of the yield curve in Canada. And one thing I want you guys to notice from this chart is how high yields have been pushed through an easing regime. Okay, so the Bank of Canada the last 9 months have been cutting rates, right? Which you would think would help ease risk concerns, right? Credit becomes a little more available. Things get easier to manage, okay? But investors in duration in Canada are seeing quite the opposite, okay? So the reason this 30-year is being pushed so high is investors are pricing way more risk in the Canadian system as a whole. What do we have to the left of that? OSFI holds domestic stability buffer at 3.5%, reflecting resilience in a changing risk environment. Okay, so that 3.5% buffer is the amount of cash these banks need to have on hand to cover withdrawals, to cover panics, runs on banks, liquidations, things of that nature. Okay, reflecting resilience. No. That is not reflecting resilience. Okay, that is the banks preparing for a riskier environment, right? For the potential for people to default, for the potential for people to run the bank, okay, take their cash away from them. All right, so this is not a positive. This is the banks forecasting a trouble scenario in the Canadian economy in the future, right? Perhaps in the near future. This is what we have to be careful with the wording of these headlines. Reflecting resilience. No, this is pricing risk, just like the 30-year, okay? Back to the short end of the curve, okay? We have the Canadian 2-year on the right, and then Bank of Canada maintains policy rate at 2.25. Okay, like I said, a little bit of financial repression if I'm not mistaken. But what we also need to understand now is that the spread The spread has widened as duration investors are pricing in term premia and more risk into the Canadian environment. The spread gets away from itself, right? So the yield curve steepens, which means over the long-term horizon, people are not seeing Canada as a good spot to allocate capital. The reason being, could it possibly be that the Canadian growth engine has been relying on short-term drivers while avoiding investments in sustainable, longevity-based projects, we could say natural resources, say data centers, things that boost productivity and provide duration support over 30 years? No. In fact, we have been relying on immigration and debt. Okay. Meanwhile, Canada sees a large drop in population amid international students crack down. Okay. One thing we need to understand, guys, is that GDP is driven by productivity plus population growth minus debt growth. When we have a shrinking population and rising debt burdens and an unproductive populace, guess what's going to happen? GDP is going to run sub 2% like it is now. And now I struggle to converse with people that have this notion that in the West we were going through like this overpopulation crisis. I struggle with the fact that people have this notion that even the entire world is going through overpopulation, when in fact it is quite the opposite, okay? This is just a snippet of it, right? If you look at long-term birth deaths, that's just been, right? Working force population, plummeting off cliffs, right? But for Canada, it's been one of the largest drivers for productivity. In fact, around the entire world, it's been the largest driver of productivity is population growth, okay? But because Canada has been relying solely on immigration for like the last 5 years to support this population growth, it leaves it subjected to new policy like this, like cracking down on immigration students, etc. Right? So then we need to choose whether we would like our culture to become diluted to the point where you might be the only white kid in your public school, or we need to suffer a GDP crisis, right? A country that cannot produce a damn thing because we don't have the population for it, right? We're stuck between this really weird limbo. And to hammer home this productivity crisis in Canada, here I have in the white is GDP per capita of the average Canadian, which sits around like $56,000 a year, right? So how rich, how well off is the average Canadian? And in the red, we have the total Canadian money supply, okay? So if you guys have been watching this channel, we know that money supply reflects the debasement rate of currency, right? Because as we have expanding money supply, the value in turn becomes saturated, right? The thing about our monetary system is that our money supply has to keep growing, right? It's inflationary by nature. But when I made this chart, I saw something really interesting, okay? So for a very long time, GDP per capita had been outpacing M2 growth, right? Which is really good. It's really positive for society. I think that's why Canada, for a while at least, had a thriving middle class, right? Because you could live quite comfortably off of a mom and dad making $30,000, $40,000 a year each, right? However, the middle class got squeezed within like the last 7-8 9 years. Okay. And it really just took COVID to break that. Okay. So during COVID, we saw the disconnect where GDP per capita went below money supply, right? And then money supply shot through the roof. And then we saw this correction. So GDP per capita kind of adjusted for that inflation and debasement. Yet we're right back into another squeeze. Okay. And this is because of our country relying on short-term levers such as this, and an over-leveraged banking sector that thinks having 3.5% reserves is resilient. And I think now this chart shows that we've entered a new regime where is basically fiscal dominance in Canada, I think is what we can call this, where servicing of debts and the debasement of owed debts from the government is number one priority, right? And ensuring that this welfare state of unproductive humans lives on through subsidies, through the expansion of money supply, and through footing the bill to the Canadians that do work hard, that are in this GDP per capita range, earning 50 plus K a year. And all the while this is happening, the Bank of Canada has come out talking about financial reforms, financial innovation. The banking system caused this, right? It's too slow for that. Debt is caused by like the pipes not being fast enough, yada yada. So they have been openly talking about now running stablecoins, pushing a plan for stablecoin regulation in Canada. And it's basically the Genius Act 2.0. Okay, so the states moved first, and then everybody saw that and was like, whoa, they just found infinite buyers for US Treasuries, right? They just found a new way to finance their deficits. And now everybody's like, we could try that. Okay. From Reuters, the Bank of Canada wants stablecoins to be backed by high quality liquid assets. And in the Bank of Canada's eyes, that is government, treasuries, bonds, T-bills, whatever it may be. These are the highly liquid assets they are talking about, okay? Now, if you dig into the legislation and the stablecoin regulation and whatnot that's being processed in Canada right now, I really encourage you to do that. Maybe I'll make another video on it. But this is a sketchy step in the direction of CBDCs and furthering state control over the individual, right? However, on a positive note, stablecoin regulation coming to these countries, coming to my country, right? Requiring highly liquid assets to back it means now that the government, if it would like to finance itself continuously, can rely on stablecoins as a growth valve to absorb new issuance, which in turn has a very, very positive effect on our good friend Bitcoin, right? Because Bitcoin is the truest, most decentralized, most free market in the world, is extremely sensitive to liquidity, expansion, and contraction, right? So when these legislations get passed, when governments begin financing through stablecoins, right, Bitcoin will know and will act accordingly. On the other hand, as states roll out regulation for these stablecoins, as they get their paws wrapped around and slowly squeeze away the freedom of individuals, it is very important to have sovereignty over our own money, right? Which Bitcoin does offer through its truly decentralized network, right, and peer-to-peer transactions. Something to consider. We can choose sovereignty and choose to exit the system peacefully by acquiring some Bitcoin, sticking it in a cold wallet, and do something productive. So if you guys enjoyed this video, drop a comment, leave a like, hit the subscribe button. Catch you guys in the next one.